valuation engines that the world has ever seen. So generally, the longer people invest, and the more of their money they invest, the better they'll do financially. So Robinhood's mission is to democratize finance for all. And what that means to us, and you can kind of see it here, is that the best investing tools should be available to everyone in the world at the lowest possible cost and with the best user experience. So that's fundamentally what it comes down to. We built a mobile app, started out offering free trading of stocks when everyone else was charging about $7.95 or $9.95 a transaction. Then we offered free options trading, commission-free options trading. We offer crypto trading as well, high-yield savings, as well as a debit card. And in 2019, basically all of our major competitors, the large brokerages, essentially replicated our business model because they were seeing how fast we were growing and dropped their own trading commissions to zero. And I thought that was fascinating. I mean, the thing that I would compare that to, I don't think I've ever seen anything like that in my professional career, or discovered it really in history. It would be almost as if, suddenly every major car maker that wasn't Tesla decided to drop gasoline and switch to electric. That's kind of the magnitude of what happened. And, some of these companies, their stock prices fell, 25, 35% practically overnight. And it led to a wave of consolidation in the industry. So some of the players had to be purchased by bigger players. So that was interesting. That happened in 2019. 2020, Robinhood grew very quickly, and that's continued into 2021. And what happened was a lot of sort of the meme stock activity around GameStop and some of the others was sort of done on Robinhood, and kind of we've been at the center of this because we provided the platform that the individual investors use to battle the hedge funds, in a word, but really just invest and trade their money.
Yeah, and if I can add to that too, I mean, one thing that I mean, just echoing this, I mean, everybody in this room, I'm sure, is familiar with the term inflation. And inflation is just how money loses value over time. And you might see, the inflation rate is only 2%, because most people think of inflation as the price of milk and the price of eggs. And in many cases, those things don't actually get that much more expensive because the farmer figures out a better technology to make the chickens lay more eggs, or milk gets cheaper because the delivery of milk gets cheaper. So sometimes things don't actually get that much more expensive. The thing that's getting more expensive than actually is creating not just income inequality, but what I call wealth inequality, is there are people that own assets, and then there are people that don't own assets. And if you don't own assets, and assets get more expensive by 10% a year, but milk and eggs only get more expensive by 2% per year, you might think that you're not being left behind in terms of, inflation, I got a 2% raise, so I'm good. But assets are actually outpacing that. So I think it's really important for people, and I agree with Vlad on this 100%, and not to overly make this about this democratization, but it's the democratization of asset ownership is so important. I mean, it's why I think it is important that people move from renters to owners, because if you own your house, that's an asset. It doesn't look like a stock like Facebook, but it actually is an asset just like Facebook stock is. So, and assets tend to appreciate, especially when we're in an environment today where interest rates are very low, the Fed creates more money. So it's really, really important. I mean, just societally, I think, in order not to have this massive wealth inequality gap, because I think you'll always have income inequality, because some people will make more money than other people. And, that's just, that's how capitalism works. But wealth inequality is actually potentially a bigger gap, because once you get left behind and assets get more expensive, if you're not actually buying stocks or owning property or things like this when you're younger, it's very, very hard to transition from kind of a renter to an owner for assets in general as time goes on, right? Because if you spend all your money on rent for 50 years, it's harder to buy a house. And if you buy a house, sorry, go ahead.
Let me just double down on your inflation comment, because so I'm an immigrant to this country. I was born in Bulgaria, and I moved to the U.S. when I was 5 years old in the 90s. So I think sometimes we don't realize how good we have it in the U.S. Because we tend to think of stocks as risky and the dollar to be very stable, right? Because it has been. But if I look at Bulgaria and what happened in the 90s, Bulgaria, basically I snuck out, or I escaped right before this. I was very lucky, but it went through massive hyperinflation in the mid 90s. So basically the currency devalued by thousands of percent, right? So, a carton of eggs would be, let's say, 2 Bulgarian leva in the early 90s. And, by 1996 or 97, it would be like 5,000 leva, right? So it would literally be thousands of times more. And so what happens in those cases are people's pensions, if they're not investing, just become worthless. Their savings become worthless. And, my grandparents who are still in the country, if they didn't have my parents who were in the U.S. sending them money, things would have been very, very difficult. So if there was something like Robinhood available back then, I think it would have led to a lot of people having a lot of people really just being a lot happier with their lives in the face of the extreme hyperinflation of the Bulgarian currency.
Wow, that was pretty powerful. I was having flashbacks of another conversation that I had in this room regarding different types of governments. So thank you for that.
And it wasn't only Bulgaria. It happened to the Deutschmark, the German Deutschmark. Obviously, in Zimbabwe, there's other famous cases. So it's actually a rarity in our country to have a currency that we consider to be stable and sort of like iron tight. And I think, people don't really celebrate that enough. I think it's actually been really amazing for the last few centuries.
Okay, I was talking to Ben. So Terry has a question, and then we'll bring back in Ben.
I do. Thank you, Felicia. First of all, I'm a layman, and I don't know a lot about this world. Again, as a creative, you just want to create and do your thing, and sometimes you leave it to the money managers, and you hope they're telling you the truth and all this stuff. But, the more I look at this, it's just what happened on Wall Street last week. It's like, you see it as a big gamble, and, and they tell you, yeah, it's a gamble. But then you also see where the house is always winning. And you look at Wall Street, they have these very complicated financial instruments that always allow them to win, and you always lose. It's like a conflict of interest, And what I saw happen last week when they would not allow people to, and I mean, a very simple understanding of this is that, people wanted to buy a GameStop, and they wouldn't let people do it. And when I listen to Vlad, and I understand what the mission statement for Robinhood is about, democratizing this for everyone. But then what happened is that, Robinhood did the same thing, and it just felt disingenuous. It kind of, I'm watching this all together, and I'm going, wait a minute, it just feels wrong, and I hope you understand that a lot of people feel just really sketchy about this whole system, and the lack of transparency. And here's another complicated financial instrument that comes and saves the day and stops people from buying it. And it's kind of like when the people use the same system that Wall Street has been using, all of a sudden they put a kibosh on it. You know what I mean? I just want to. Do you understand the how it doesn't feel or it doesn't look right in a lot of ways? But
oh, totally. Yeah, I totally understand that. And at first when this happened, my what I would say is every other broker pretty much did something like this, right? It wasn't just Robinhood. And, that's unsatisfactory, as it should be, to customers, because Robinhood stands for something, and it stands for individual investors being able to do pretty much whatever they want, as long as it's, subject to all the regulations and the laws. So when Robinhood disappointed them, and obviously the reason is not because we sided with the hedge funds or did anything like that, but the reason almost didn't matter, right? People wanted to buy the stocks that they wanted to buy, and when they couldn't do it, and it felt like Robinhood was stopping them, it sort of like violated the idea that they had in their minds of what Robinhood stood for. So I totally understand that. And look, I'm a creator too. Beju and I, who's my co-founder, we built this product with our bare hands. He designed it. I coded a lot of it. So obviously when people are unhappy or dissatisfied or upset about anything, it sort of, bothers me very, very deep inside, and I want to fix it, right? And that's why earlier this week, that's why we did several things. First of all, we wanted to remove the restrictions over time, and that involved raising $3.4 billion in 72 hours, right? Which, if anyone here has raised $3.4 billion in 72 hours, it's not the easiest thing to do. It also means you probably aren't getting the best terms because you have to do it so quickly. And I took immense, I'm not worried about this, but I took a financial sacrifice in order to do this quickly, just so that people could have the freedom and the ability to buy the stocks that they want to buy without these restrictions. So, I have skin in the game. I'm aligned with making a better future where people don't have to deal with these restrictions, and making it so that there is a level playing field. And I think there's more to do. But, one of the things that became clear to me also is I was kind of acting like just a market participant, like Robinhood is subject to all of these rules and we just have to follow them and play by them. And that's what it is. And I kind of realized that customers want more than that from us. They actually expect us to say, hey, if these rules aren't working or the system isn't working, this is exactly how you change it. And these are the steps that you have to take. These are the people that have to be involved. And this is sort of the path to a better future. And I do believe that we can drive that. And actually, I believe that if we drive that, it'll be better for everybody, not just individual investors. I think that if we can lower the sort of money that's gumming up in the system, it's going to be better for every market participant. And it might not be better for some, but I think it'll be better for the markets overall. Hopefully that answers your question.
Yes, thank you, Vlad, and I agree. Thank you.
Well, I think it might be helpful as well, just to really articulate in the clearest way possible what happened. Vlad, I can give my perspective. You had the wake up call at 3 a.m. or whatever it was with your perspective. But again, it takes 2 days for these things to clear, and that's idiotic. We use computers now. It used to take 5 days because people would, I guess, in Manhattan drive, have their horse go from one brokerage house to another brokerage house to change the paper stock certificates and money. Now it takes 2 days. And again, there's some risk. It's very, very low, but there's some risk that what if the buyer doesn't show up or what if the seller doesn't show up? So let me just give you an example here. Let's just say that I am buying Apple stock, and then you're selling the Apple stock. If I don't show up with the money, Apple stock might go down a little bit over this 2 day time period, but it's not going to go down by 100%. Maybe it goes down by 5%. So the collateral that you would have to put up for that trade during this 2 day period, which again should be 0 seconds, but instead it's 2 days, is going to be 5%, roughly. I'm oversimplifying this, but it's 5% because it's called value at risk. The value at risk is not the full value of the Apple stock. The value at risk is the amount that Apple stock might go down. And because Apple's a $2 trillion company and everybody in this room has an iPhone because it's Clubhouse, it's just not going to go to that much. If you take a much more volatile security, volatile means the price is swinging up and down, and it could go up 100%, it could go down 98%. It's how do you calculate the value at risk there to the seller? Because if I'm supposed to buy, you're supposed to sell, and I don't show up to buy, you could lose 100% of the value in that 2-day period. So the collateral is much higher, but the collateral cannot come from the customer. And it's like this whole system just makes no sense. And therefore, it's really hard to explain to people. And I think a lot of the news has just been very misleading on this, which is like, oh, these guys did this, these guys did that. And as Vlad said, it was every broker had this restriction. In fact, a lot of the prime brokers that hedge funds use also had restrictions in place for buying because the collateral was just way too high, because it was based on this idea that the value at risk was the entire value of the thing that you were trading, as opposed to the amount that it might decline. But here they were one and the same, if that makes sense. I don't know, Vlad, if you want to kind of input your take on this. It's a complicated topic, but like that's the problem, is that like I think a lot of the news that I've read, like 99 times out of 100, it's always been wrong because these concepts aren't super well understood.
Yeah, I'll just I'll add one thing to what you're saying, and then I'll kind of give the sort of layman's 2-sentence description of what happened that Thursday from Robinhood's perspective. But just adding to what you said, there was this law passed in the aftermath of the last financial crisis called Dodd-Frank. And I think some of you might have heard Dodd-Frank mentioned in connection with this. And I don't normally read all these documents, but I actually pulled up Dodd-Frank and started pouring through it. And this is actually all spelled out there. Like, Dodd-Frank specifically spells out how the NSCC clearing deposit should be computed and how that should be regulated, and includes all of these things about value at risk. So I just thought it's interesting that Congress, to some degree, just like specified how this should work. And so moving on to kind of the simple explanation, basically there was such a huge increase in activity and interest specifically around these stocks on Robinhood that Robinhood didn't have the money it needed to continue trading of them unrestricted. So we had to restrict them. And on Thursday, that restriction was very blunt. It was basically no buying. So customers that had the positions could still sell, but no new customers could buy. Friday morning, we allowed customers to buy limited quantities. So there were pretty small limits because a lot of the capital we needed to increase them was still in flight, and we were kind of waiting for that to land. Monday, the limits increased. They increased a little bit more till they got quite high, and then eventually we removed them. So that's in a nutshell what happened.
Fab wants to jump in, and then Ben.
Yeah, Vlad, I appreciate you breaking this down, but it's interesting in this time of the pandemic, which seems like it's been the great accelerator for so many interesting things. And you just, when it's always going down, I just think of all these people out of work and at home, and they're on their computers, just trying to make a few dollars. And then this incredible thing happened. I'm just curious, how you anticipate, because obviously this genie's out of the bottle. It has empowered all these little investors that you sought out to serve. So I'm just curious about how you now foresee this mass of people moving, this networking effect kind of multiplying now, and how that's going to affect your business and possible, other hedge funds who have, lost many, many billions of dollars.
I'm not sure, to be honest. I mean, I think I have some guesses, but it's almost like, does a cell really know what's going on in the body? Each participant in the network, each individual has sort of a limited view into how the network as a whole behaves. So I can tell you, from our perspective, we want to be reliable and available for customers. And so, we have to make sure that generally when they want to transact, when they want to invest, they can do that. And if they can't, we have to be really clear and transparent about why they can't. And we're going to do that. I think we have been improving already. I don't know what it means for short sellers. However, I think short sell, it's an interesting question. If you are aware that, this other sort of retail investor exists that maybe you didn't have to worry about as much a couple of years ago, I could imagine that, if you're a hedge fund, you might be afraid to short as much. And that could have ripple effects that are unanticipated, right? So yeah, I think that's kind of the obvious one here. There will probably be people or hedge funds that are much more worried about engaging in short selling strategies.
So I want to bring in, I actually have a brother in the room who actually lives in the future. So Mark, what are your thoughts on what this is going to look like moving forward in the future, 5, 10, 20 years from now?
Yeah, so I think this was a really big moment. I think this is a really big deal. And basically, like, if you take kind of everything that Vlad was saying and you take everything that Alex was saying, and if you kind of take it up kind of one more level, like, I think this is sort of one of these sort of moments where you realize the internet broadly is moving into a new phase. And I guess the way you could think about it is maybe the internet's been through 2 previous phases. There was a phase in which there was just no money on the internet at all, which was like in the 80s and in the early 90s. And then there's this long phase we've been in for the last, 20 years, which is where, sort of advertising is the central kind of business model of the internet. So you have all these, huge, obviously, services like Google and Facebook and many others, that don't charge you, the consumer, right? But they sell advertising. And of course that has its pros and cons. And there are various, kinds of issues with that as a model, which gets discussed a lot these days. And I think what this indicates is I think we're moving into like the third phase of the internet, in which people are not just clicking on things, and they're not just voting with their clicks and sending messages, to companies and politicians and each other and so forth with their clicks, but they're also voting with their dollars, right? That individuals directly are now controlling the flow of money online. And I think, like, if you think broadly about that, maybe the first, obviously, e-commerce is a part of that, but that's just buying something, right? That doesn't have kind of other effects. But if you think about like Kickstarter, Kickstarter started like 15 years ago, and maybe that was like the first example of this, with this rise of the idea of crowdfunding, right? Which is basically, if like 1,000 or 10,000 or 100,000 people get together on Kickstarter and all, decide to contribute $10 or $20 to a project, that can cause a project to exist, to make something that wouldn't have otherwise existed in the world. And then over the last, several years, you've seen these new models, there's Substack, where you pay directly for the content you want. There's GoFundMe, where you can, raise money for causes. There's sort of a variety of these new models. There's Patreon, right, where you can kind of fund and subsidize artists, right, who you admire. And so there are all these new models in which you can basically vote both with your clicks and with your dollars. And then in aggregate, you and a lot of people who you maybe knew ahead of time or maybe didn't know ahead of time can all of a sudden be not just like a cultural force online, or not just like an expressive force or a vocal force, but also a financial force. Right. And so like the fullest version of this is, from what Vlad was saying, the fullest version of this is maybe the internet itself just became the world's biggest hedge fund. Right. And maybe the ability for people to organize on, these message boards and on these social networks to be able to devote money, small amounts of money per person, but tens or hundreds of thousands or millions of people in aggregate, all of a sudden bringing kind of, bringing the level of money that traditionally only these huge institutions have had, and being able to participate on an even footing. Like, that's a brand new thing. And so I think you're going to see a lot more of this kind of thing happening. I think it's going to have a big impact in the financial markets. I think for sure it's going to have a huge impact in politics, and probably in a lot of other fields as well.
Felicia, can I say something?
Yes, jump in, Mike. How are you doing, Michael?
I'm doing great. Thank you very much
Good
for
to see you, brother.
hosting again. Mm-hmm. So I'd like to amplify what Mark said, because I think that we have to underscore just how seminal a moment this was in the investing world. Spending most of my time in that area, I lived through the Ackman Icon feud and debate and buying and selling and them going after each other. And then obviously lived through the situation with GameStop and Robinhood, and what was being said by prime brokers and by hedge funds and even by friends of my daughter that were investing through Robinhood. It's fascinating in that no one really cared what occurred between Ackman and Icahn. It was two guys with a lot of money, big hedge funds, and battling it out. What we saw here, as Mark said, for the first time, was a group effort of small investors, all of whom had something to say, but the ability, because of the internet, to communicate instantaneously and create extraordinary market shifts. I'm not commenting on whether it was right or wrong. I'm not going to comment on whether shorting is right or wrong. But I will say that the attitude and the how hedge funds and banks view shorting any company right now has changed forever. And I think that I was brought an idea of a short just Friday by a large institution, and I hesitated, didn't do it, because I didn't know what the group think might be on the situation. And as Mark said, the internet provides that ability to be able to vote with your feet and with your money, even if you don't have millions of dollars. So I personally think this is a seminal moment in the history of investing.
Hey, Felicia.
Felicia, can I ask
Gail?
a question? Yeah.
Yes, and then Gail, and then Ine. Go ahead. Thank you, Michael.
Glad, I'm wondering how difficult a decision it was for you to decide to block it, to shut it down for the GameStop buying. And did you have any idea that people would get so angry, and how did you deal with that anger? Did it ever frighten you because they got so pissed? So I'm wondering how difficult it was to make the decision. And then number two, how you dealt with the anger that was all the incoming that was coming your way.
So you might not be the true answer is I didn't make the decision. This will get into a few of the details around how Robinhood works, but Robinhood actually has a holding company with a few other companies underneath it, right? So I'm the CEO of the holding company, and kind of my responsibility is to provide technology services and capital to the three subsidiaries. But Robinhood Securities, which is what's known as a clearing broker, makes the decision about what securities are tradable and untradable and what those limits are. Ultimately, the team at Robinhood Securities made the decision, and it wasn't really a decision that we had a choice to make. It was basically we had to make the deposit. We had to prevent that deposit from growing out of control, and we had to act very quickly. And the consequences of not doing that would be, I don't even want to think about it, right? We would have had to potentially limit trading of all stocks.
Well, let's just say I only knew your name. I didn't know the other people's names. So I was just wondering, you seem to be the face for a lot of people, rightly or wrongly. It seemed to be,
for sure,
to fall on you. Yeah.
Awesome. Hey guys, Ime here. I had a question, given we were doing this little retrospective right now about the significance of this moment, and I know that there's still things that are left to play out, and we'll see, what this moment actually turns into. I'm curious. Does anyone know who made money during this? I.e., all of the retail, or not the retail, but the armchair investors, most people were calling them. Ultimately they rallied. That was the community that formed on Reddit. As they are sitting here now, I know the stock's gone down on the GameStop side by a couple percentages, but still is probably pretty high vis-a-vis where it was before the rally started. Just like, will the retail or the armchair investors walk away from this saying, "Oh, this was a worthwhile strategy to take"? And will we see more of these community-driven kind of investment strategies happening? I don't know if Mark or Michael, you said that you had your daughter that got into the mix and definitely bought some. She's still sitting pretty with her GameStop stock and thinking about holding it for a little bit longer, or kind of what's happening right now?
Well, I think it's a really good question. I think it's very hard to judge all this. The one thing we know for a fact is that many of the large funds that were short the position fell victim to what Alex described very articulately early in the conversation here. And they had to cover, and we know from public record that one fund had to take in $2.5 billion of investment, most of which went to cover their shorts. With the younger people that I talked to, most of them were in or out. But when I was called and asked for advice, I gave the same advice, which is only put in what you're willing to lose. And secondly, understand that at some point with these musical chairs, the music stops when you're shorting. And when you stay at the table too long, you can get an enormous amount of trouble. I don't think, and maybe Mark Andreessen knows the data on this, I don't really know what the smaller investors lost. We read a lot about what a few of them made in gossip columns, and in and particularly there was a lot of it covered in the New York Post. I do know that multiple hedge funds were down severely. So there's good news and bad news about that. The good news is that, as we just discussed, and as Mark said, there's a new way to play this game, and it can be played using the communication tool of the internet with a lot of smaller investors. But a lot of people have not taken into consideration that the hedge funds that lost money, probably a substantial portion of the money they lost was not for wealthy individuals, but for major pension funds. So a lot of people that were in those pension funds, whether it be Ontario teachers or Texas teachers, there are a lot of pension funds that lost half of their investment in these particular funds. So it's good news and bad news. The good news is this seems to have created a check and balance, and the bad news is there were probably a lot more losers than winners.
That's right.
Go ahead.
No, I was going to say it's hard. There's no perfect accounting. I mean, maybe only the IRS will know, probably. So they're the only ones that will have the answer. We should have the IRS in the next clubhouse. But I would say, there are different ways of investing, and there are ways of investing around kind of craziness like this. And actually, if you read a lot of the stuff on Reddit leading up to this, some of the original analysis on GameStop was really, really good. Around this particular play, which was, this was the craziest of craziest. It's this is the Hail Mary of football plays, which is, all right, 140% of the shares are short, which makes no sense. $250 million market cap. If you do this and this, and we get 10,000 people to do it, we're gonna run over all these hedge funds. This was kind of the analysis, very technical, very articulate, the kind of thing that you would have a smart economist write. And then there were a lot of people that didn't really know what they were doing, but they're like, I'll go in on this, why not? And some of them made money, some of them lost money. But again, there are different styles of investing. Some people I know, and this is what's I think different about investing today versus 50 years ago. It's I know people that love Peloton. They ride Peloton 4 times a day. And there are a bunch of investment analysts who say Peloton's overvalued. I have a sell rating on the stock. Peloton sucks. But you have people that love to ride it. Those guys are idiots. I ride this 4 times a day. I got 5 of my friends to go buy Pelotons. I'm buying Peloton stock. There are just different styles for investing. So, one of the takeaways for me is I don't want to over popularize or sensationalize this. As more people get into investing, they're going to go in on these crazy Reddit things like GameStop. I think this was a really interesting moment in time, going back to this, we've had this happen with hedge fund versus hedge fund all the time, but we never had, the small short with the $250 million market cap company that somehow ballooned up to $25 billion, crushed a bunch of hedge funds, forced those hedge funds to sell all their big positions, in Facebook and Google, which kind of crashed the market a week and a half ago. That's never happened before, and it's really interesting. But I think it's just one strategy behind this. How do you democratize and popularize investing and owning what you believe in? And there are some people behind the GameStop trade that really believed in GameStop, and that's great. But there are going to be a lot of other people that say, you know what, I'm not just going to keep my money in my Bank of America checking account paying 0% interest or earning 0% interest and paying overdraft fees. I'm going to go buy, 3 shares of Peloton. I love that company. Or, 4 shares of Apple because I bought, 5 iPhones in the last 7 years. And I think that's fundamentally a good thing. And maybe some people will say, I'm just going to buy low-cost index funds. Some people will say, I'm going to buy Peloton. But, the more exposure that we give people, I believe in letting people make their own choices. And I think the more exposure that we give people to assets, the more that we empower a new generation of people to actually build up wealth over time. And that's what it is. And this is going to be one part of the story. It's a big one. It's gotten a lot of news. But it's not like, you're going to have masses of people. They're going to buy, crazy companies and bankrupt hedge funds. I think this is kind of anomalous. It's really exciting, but it's still anomalous.
Let me throw one other thing in there. Since you mentioned shares a couple of times, one, I think, somewhat underappreciated innovation that's hit the financial markets in 2020 is the ability to buy stock in a dollar amount. And Robinhood, I guess, popularized this, where you don't have to really understand shares. And sometimes we found when talking to customers that they really just say, I want to buy $1 of a particular stock. And it just makes it much more understandable, and you can kind of perform that transaction or buy that stock more simply. Now, in this particular case, what it also does is allows stocks that have high prices and increasing prices to continue to be bought. What you saw with things like with stocks that are trading in the thousands of dollars, or even in the case of, for example, Berkshire Hathaway for hundreds of thousands of dollars, allowing someone to buy $1 of that can be very, very powerful. And I think, sometimes that's underappreciated, that innovation actually allowed more people to enter the markets.
Well, the question is entering the market with their eyes wide open. Marilyn had a comment regarding the young people who bought and sold and dealing with capital gains. Marilyn, do you want to jump in with your comment?
Yeah, you know what? I just think that part of the story doesn't get told much because people see, the young folks, they bought the GameStop, they bought AMC, they made all this money. But the other part of the story that people just need to understand is that if they buy it and they sell it right away to make money, they get hit with huge capital gains taxes because most people probably know that if you don't hold the security for a year and you sell it within that period of time, you have to pay a huge capital gains tax. And I just think that that's something that people need to be sensitive to if they're thinking about getting in the market and getting out of the market to make a profit. You have to always think about the taxes because the government's going to get its share regardless of what you do.
That's true. Only a problem if you make money.
Exactly. Right. And then if you have a loss, then you can write it off against the loss. But if you make money, you've got to pay the tax if you sell it in a short period of time. Absolutely correct.
My dad taught me growing up. My dad taught me growing up, you can never go broke making a profit. So I always try to take that home with me every day.
I'm going to borrow that one. I like that.
So Fat wants to jump in, and then I want to get Ben back in. Go ahead, Fat.
Yeah. So I wanted to get Mark's opinion on this because this is such a real pivotal tipping point moment culturally and on so many levels for so many reasons. Mark, the housing collapse and the banking and all that stuff that happened, that was the accelerator, if you will, for blockchain, Bitcoin, crypto. And now we've just had this major turning point moment, Reddit rebellion, people on their computers doing, what they did to kind of win. And now we are at the kind of beginning of decentralization and DeFi. I'm just curious what you think that could look like as we go forward. Like, how could that improve these situations as more and more people dive onto these new burgeoning platforms?
Yeah, so the book that I really like on this topic that I'd really recommend, a friend of mine wrote named Martin Gurri, Gurri, and the book is called The Revolt of the Public, which is a great term, and then it's something like The Revolt of the Public and the Collapse of Authority. And basically, it's actually interesting because he wrote the book even before this, and he even wrote the book before the 2016 election, so he kind of forecasted a lot of what's happening. sort of the big observation he made is just like, look, like basically if you like look at polls, like Gallup does these polls of like how many people trust large institutions. The numbers have been falling almost across the board for almost all large institutions since the 1970s. Right. And so like, people who trust the, federal government, state government, people who trust, big banks, people who trust the media, people who trust organized religion, people who trust, like it basically just across the board. These numbers have all been falling, basically coming on for 50 years, and they're continuing to fall. And by the way, some of them are getting very low. And so there's a very negative way to interpret this, which is, our culture is becoming very cynical and very angry. And you kind of obviously have, people probably have a real kind of emotional sense of that. Obviously what we're going through right now with COVID has caused, additional declines. People are now very deeply distrustful, of various, parts of the government that maybe screwed up testing or maybe screwed up the lockdowns or maybe aren't reopening schools, or maybe aren't approving vaccines fast enough or, getting vaccines into people's arms fast enough. And so there's like this accelerating collapse of trust in institutions. And exactly to your point, like the global financial crisis is a perfect example of that. It was a huge blow, to the trust and credibility of the big banks and of the government's ability to manage the economy. And so there's this bad news kind of interpretation to it. And of course, you can worry about the consequences of that in lots of ways. But there's also a good news interpretation to it, which is, put bluntly, like maybe they don't deserve our trust. Right. And maybe they did deserve our trust at some point, and maybe they don't now. Right. Or maybe they never deserved our trust and we just didn't have any alternatives. And there was just nowhere else to turn. And then to your point, like basically what's happening is that the tech industry is furiously at work, both in the form of a lot of startup companies, but also just a lot of open source projects and a lot of these decentralized projects like DeFi, basically coming up with entirely new systems, many of which are much more bottoms up, right? Much more distributed, much more decentralized. That are basically providing more and more alternatives for many of the functions that the big centralized institutions used to provide in the past. And then this is happening probably most dramatically in financial services in the world of money. And so I think there's this huge basically fight that's forming up between the people who are going to want to hang on to the old institutions, even though people don't trust them anymore, and then the people who are going to advocate for these new decentralized approaches like DeFi. Even though you might say that they're not completely proven at the same level of scale.
Fab, did you answer that? You good?
Oh yeah, thank you, Mark. Thank you so much.
I want to bring in Jules and then Ben. Jules.
Hey, so I just had a quick question in regards to some that Alex had mentioned earlier about that's crazy that there's this 2-day waiting period to make trades when, in the 21st century, it should be instantaneous. So I'm wondering if, now that we've had this big, the GameStop incident, do you think that, or really like anything about the stock market is going to change, or like in a month or two from now, it's literally just going to be same old as it was before?
Well, I hope it will change. I mean, T plus 2 makes no sense. And actually the history on this is in 2004, we went from 5-day settlement to 3-day settlement. And then it took another 13 years. I'm not exaggerating. In 2017, we moved from 3-day settlement to 2-day settlement. So over 13 years, the geniuses figured out how to cut this down by an additional day. And this should just be real time. But it's not a technology problem. It's just you got to get everybody in a room and agree. And you need, in many cases, like you need the government to take a leadership role here as well. Like the SEC took the leadership role on T3 in 2004. They took it in T2 for T2 in 2017. So like they should do that here. And then, my view is like, I actually really hope that there aren't a bunch of ill-informed fast track laws that come out of this, because all of these problems are solvable. So like actually one thing, we did a Clubhouse on this a few weeks ago, but take a company like AMC, which isn't doing so great because I don't know about you, but I'm not allowed to go to the movie theater here in California, and AMC operates a movie theater. So they're running out of cash. So their stock goes up because they also had the same kind of short squeeze dynamics. All the hedge funds were short AMC. The Reddit army decided to go buy AMC or buy options. It caused the short squeeze. The price went up. You know what AMC did? They were like, wow, our stock price went up. Let's sell lots of stock, which they can do, but it's kind of complicated to do. So a company, normally you just have shares of stock in the company, and a company can issue more from time to time, but there are different restrictions on when they can and can't do that. For example, like what if they know their earnings are really bad? they have inside information that they have bad earnings. They can't just go sell stock to an unsuspecting public. It's meant to protect the public. But, AMC, they were able to do what's called an at-the-market offering. So they sold lots of stock. They got hundreds of millions of dollars of now cash in their bank account. Their stock price went back down, but they're better off for it. And this is actually what creates a feedback loop. The human body it's a feedback loop, and it kind of gets to equilibrium. If your temperature goes too high fighting an illness, well, that's designed to kill the illness, and then your temperature goes back down, right? It's a feedback loop. So the feedback loop actually works. The feedback loop could be if your stock goes up too much and it's 100% short interest, blah blah blah. Well, then the company gets to issue more shares and now is better capitalized. And if there are more shares, it's easier for the shorts to cover their short. And therefore, if that happens, then probably, you'll have less of these kind of DDoS attacks, distributed denial of service attacks, if you will, on the hedge funds or on the companies themselves by buying the stock, Reddit style. So I actually think we have mechanisms today to solve all of these problems. But the number one that I know Vlad and I are very much aligned on, just from kind of independent perspectives, is T+2 got to go. That doesn't make any sense to anybody. It makes sense if you're a buyer in some cases because you have more time to come up with the cash. But it made sense in the 1900s or the 1800s. It doesn't make sense in 2021. So that's the number one thing to go, but it just requires coordination as opposed to we don't need a new tech company to go solve instant settlement. We just need all of the participants in the market to agree. This old thing where we used to schlep stock certificates via donkey across Manhattan, and that's why we have T+2 today. That doesn't make sense. Let's go faster. And then I think we can actually deal with all of these situations and all of these crazinesses that are happening if we let companies issue more shares, as one example, versus one of the issues we talked about, wealth inequality and whatnot. There's this whole thing, not to get on a tangent, but it's called the accredited investor rules. So unless you're rich, you're not allowed to invest in companies or in certain investments that do really well. How terrible is that? Venture firms sometimes post great returns. Private equity firms post great returns. They're not open to the general public. That's designed to protect the general public. But really what it does is it protects the general public from getting access to some things that actually perform really, really well. So I'd hate to have more laws that look like that, which are very well intentioned. The intention is let's protect people from themselves. But the reality is it's let's protect people from actually becoming owners and generating more wealth. And that doesn't make any sense. So I think we have all the laws that we need. We just need more organization around T+0 or T0.
I completely agree with that. And I think it's super silly that you can buy, a $2,000 TV on your credit card and get that delivered next day, but you can't invest $2,000 into a startup. I think sophistication has been equated with how much money you have in your bank account. And that's also an outdated model that's going to have to change. But that's perhaps a battle for another day.
Ben, can I get you to jump back in? Yeah, there we go.
Sure. So I have a two-part question for Alex. And this is kind of... so going back to Terry's question, which I've been thinking about since he asked it because it's really interesting. He was kind of asking, look, can we trust the system at all? And then we've talked kind of since then about, okay, we have these crazy time delays in trades, and those intersect with a giant document called Dodd-Frank, which can basically seize control of, of some individual participating in this big cultural movement and stop him from trading. So, it is complicated and it didn't work. And can you trust it going forward? I guess is the first part of the question. And how do you think about that? And then the second part of the question is, when you look at the Big Short, the thing that caused the Big Short, I think, is pretty clearly you had our large institutions, our banks, and banks, hedge funds, et cetera, taking these enormous financial risks to earn a relatively small amount of money. So basically making very, very risky loans underwritten by the American public in exchange for them getting, basically, as Nassim Taleb said, picking up nickels in front of a steamroller. It seems that in the small short, these hedge funds in order to win a possible prize of $300 million, lost $30 billion, which also seems like they were picking up nickels in front of a steamroller. Did this reveal a different kind of systemic risk? Should we be worried about the risks that hedge funds are taking, their links to our banking system, and then their links to the taxpayer who's underwriting all this? Could we have another crisis?
It's a great question. So let me answer the second part first, and that's why I brought up long-term capital management, which is the most ironically named company or firm of all time, given that it went bankrupt in a very short period of time. But this was a very, very seismic event in 1998. And again, this was when Russia, they had Nobel Prize winners up the wazoo, or I think two of them working at LTCM. They went belly up because Russia defaulted on their debt, and there was an Asian financial crisis the year before, so that's obviously bad. And the Federal Reserve of New York actually organized a bailout of them. And this is, you could expect something like a Russian sovereign debt crisis to cause lots and lots of people to lose money. It's kind of I guess that's more of a white swan if you look at the history of Russia, but it happened. You can imagine that that's bad. And I think your question is great here, because it's like, who would have thought that GameStop would pose a systemic risk? And the reason why I called it the small short is because it wasn't just that the hedge funds lost money on GameStop. It's like if everybody was short, and it wasn't just GameStop. There are a lot of names a lot of hedge funds, they'll try to run they're called hedge funds because they don't just buy things and hold them forever. They're hedging. The way that you hedge your longs, the things that you're buying, is you want to have some shorts. Otherwise, you don't deserve the title of a hedge fund. So a lot of hedge funds were losing money, and then they had to sell off all of their big positions that were good. It's like, oh, Apple stock, that's not going to go down. Wait a minute, if every hedge fund is in Apple stock, and some of these stocks are popularly called hedge fund hotel stocks, because every hedge fund, despite hedging, they're all in Apple, they're all in Facebook, they're all in Google. They all buy these mega names. And there's hundreds of billions of dollars of exposure there. If a bunch of these shorts cause the big hedge funds, in order to meet their margin calls, to go sell off the big stuff, that could actually cause a precipitous decline, all caused by a 5,500 store, game retailer like GameStop. It's kind of ludicrous to think about, but that's the systemic risk. However, this is what I was kind of getting to with Jules. It's a really easily solvable problem. Let the companies sell shares. I mean, this is going to kill the trade to bankrupt the hedge funds. But the way that you would solve this problem pretty comprehensively is say, okay, GameStop, you can sell as many shares as you want. Like, go print 100 million new shares, sell them as a market participant. And then, boom, you've got more money. And because you're able to print more shares, now there's more supply. Prices are a function of supply meets demand. And now everybody can cover their shorts. So unfortunately, the hedge funds don't lose as much money. The Redditors don't make as much money, but there's no systemic risk to the system. And so I think we solved that problem. I'm not as worried about that. To your first question, I mean, it's related, because I just worry, Dodd-Frank, a lot of legislation there are two ways of reading legislation. Sometimes it's well-intentioned, but has consequences that have not been foreseen. And sometimes it's poorly intentioned because lobbyists effectively write it, and then Congress people, have 24 hours to read it, and they just sign their name and vote for it anyway. So I think there's a lot of stuff in Dodd-Frank that doesn't make sense. That might need to be reformed. I just don't know how we do that. I mean, my hope is that if we just move to T+0 or T0, not waiting 2 days to settle things, which is much more of a consortium approach, as opposed to, we don't need Congress to pass a law to do this. I don't think we need Congress to pass a law to do anything about the whole different set of situations. And I think any set of laws that are passed, they always have these downstream consequences, like the accredited investor rules. Again, well-intentioned there, but actually bad consequences for a lot of people. So my view is that I don't really foresee any changes to the law. I'm not a political expert, but I think we can solve, the industry itself just needs to get together and say, how do we stop things like this from happening? because it's a bad look for us, for sure. But it doesn't make any sense anyway when we have technology that can solve these problems for us, like immediately. Like we can clear every trade instantaneously. There are other countries and other systems that already do that. Let's do that here too.
Thanks. That was great. Excellent explanation.
I just want to jump in and ask Alex a quick question about the rollout of like the PPP seemed quite challenging, to say the least. Why was it so complicated, and how could that be fixed?
Oh, that's a very long question, or it's a very short question. It's a very long answer. So, PPP was the Paycheck Protection Program, and this was this was well-intentioned, very, very poorly rolled out. And part of this is the government actually doesn't really know who's a small business. Because, if you're a small business, you file your taxes and you have like a rough accounting, like it's your Schedule C on your tax return. Here's how much money I spent on rent. Here's how much money I spent on this. But they don't know every day what your sales are. So if you're a small business, if you're a restaurant, as an example, and you're not incorporated, it's just a sole proprietorship. And it's just like, if it's me and my wife, we run a restaurant, and we used to have sales. Now we have no sales because the government says, you got to go close your restaurant. The government doesn't know how much I've suffered. They don't have a way of sending me money because the IRS receives money. The IRS actually sends out a lot of refunds, but Congress people, I don't think, have a great idea of how all of these different systems work. So okay, we got to get money to small businesses. Who can do that? The Small Business Administration. It's a cabinet level role, but there's something called the Small Business Administration. It's part of the federal government. They don't normally make loans. They'll make some loans if there's like a hurricane or something, but normally what they do is they backstop loans. So banks make loans to businesses. And then if the loan is kind of questionable, the government will say, if the loan goes bad, we, the government, back it. So you get the money from the government, which is the sovereign. So no chance of losing money. So bank make the loan anyway. So that's what small business loans are. And this once in a 100 years, because we had the Spanish flu over 100 years ago, this once in 100 years kind of problem, we're like, okay, we need to get money to small businesses. It shouldn't be a loan, right? Like, why are we loaning them money? The government's shutting down their business in the name of public health, but like is ruining their business and destroying livelihoods nonetheless. We need to get the money. We don't want to call it a loan, but we already have this thing called the Small Business Administration. So we'll just let them do it. But the Small Business Administration says, well, we don't do that. That's what banks make the loans. So banks, you go make loans to businesses. And banks are like, what are you talking about? This isn't a loan. This is a loan that you don't have to pay back. It can get forgiven. And then small businesses are like, well, which bank do I talk to? Do I talk to this bank down the corner? They don't do these loans. Do I talk to this bank, Chase? They don't even respond to my emails. So it was just a cluster. And it just was not very well conceived. It's one of the reasons why I think, and I hope in the future, there's a way for businesses to actually receive money from the government and send money to the government directly, almost like a bank account. It's not saying that banking should be nationalized. I love the idea that, I think banks and only banks should be taking risks and making loans to people and potentially taking losses or making profits. That shouldn't be the role of the government. But there should be a way, like maybe my social security number is actually like a little bank account. So if I receive money from the government or send money to the government, it doesn't have to go through a bank. And the same thing goes for businesses. So it's a really, really long story, and I was involved in some of it, or trying to help in whatever way I could. But it was just such a disaster because it had to get funneled through existing systems, through existing banks. Banks don't do it. It wasn't supposed to be lending. It was supposed to be almost like an outright gift of money to make up for these catastrophic closures or the catastrophic effects that they've had on small businesses. So that's kind of what went wrong. We have another round of it right now. It's a little bit better, but like every small business in America probably uses QuickBooks. There should just be a button in QuickBooks that says, hey, click here, get money from government. We saw that your sales went down by 40%, or we'll just cover all of your employees' payroll. Like, boom, done. And actually, a lot of countries in Europe have something like that. We're just unfortunately way, way behind. We talk about like infrastructure. The United States doesn't have the best infrastructure. You think about that from like, oh, this highway is falling apart, or this road quality is bad. But in many cases, or unfortunately in a lot of cases, we don't have great infrastructure from a financial services perspective and also from a technology perspective in terms of what the government does.
Well, my mic was on mute the whole time, and I was going, what? So, wow, thank you for that explanation. It's pretty sad. I'm going to get back in. Mark Andreessen?
Yes, please. How can I help?
I just love hearing your take on everything financial. So just share your thoughts before we start winding down.
Yeah,
look. Back to Vlad and GameStop, or we can talk about the PPP or whatever you like.
Yeah, look, well, maybe I'll just make maybe make two final observations, like sort of twists and turns kind of along the GameStop story that I think people might be underestimating, that both kind of indicate how big of a deal I think this is. So first is, it's actually really interesting. If you go online, and you can actually go online and you can actually watch the video that originally kicked off the whole GameStop thing. It's quite interesting. It's like a 5-minute video. Somebody will remember this. Vlad, you'll probably remember, but the guy who does the videos on YouTube, is it Roaring Kitties or something like that?
Deep Value, I believe, is his legal name.
So but Felicia, is this a family show, or can I use a bad word?
Go for it.
So this guy's Reddit handle is deep fucking value, one word. And then he's got a YouTube account that I'm sure you can find if you Google him. I think it's like Screaming Kitties or Roaring Kitties or something like that. So he's the guy who kind of initiated this whole thing. And by the way, it turns out he's one of these characters. His real name, I think, is something like Keith Gill. And he basically is just like this financial planner, I think, in like, I don't know, somewhere in the Northeast, who just like sits, he's like, by the way, apparently like normal guy, wife, beautiful daughter, sits at home, goes to work during the day, and then goes home at night and dresses up in his gaming outfit and gets in front of his gaming PC and does all this internet stuff. And so anyway, he put this video online, some months back, kind of kicked off the GameStop thing. There's a couple interesting things about it. So one is like, to Alex's point, like he makes an argument as to the underlying value of GameStop. Like, and so he makes what's called a fundamental argument. Which is basically that this company is still, coming out of the pandemic, this company is still going to be valuable. They own a lot of stores. People like to buy a lot of things, at GameStop, and so this stock is undervalued. But then he immediately locks in on the fact that 140% of its shares are sold short, and he immediately says, "Look, like this company should be more valuable, but like in addition to that, like this is the potential short squeeze." Like he basically like decodes the whole opportunity and just lays it out, and in like 5 minutes. And so the observation there is like, he is actually professional. Like his day job is a financial planner, so he understands some of this stuff professionally, but like he had a sophisticated read on the situation. Like he didn't go into this like naively or like not understanding what he was doing. Like he knew what was what. And, and by the way, he could have been right or wrong, or whatever, people could have ignored him, but like he knew what he was doing when he made this recommendation. Like it was not an accident. And so this just goes to the fact that like, just because it's like a mob of like crazy people on Reddit does not mean that they're not sophisticated, right? And in this case, at least the people who got this whole thing going and kind of really catalyzed it actually turned out to be quite sophisticated. And many of the discussions on the internet about what's happening, kind of in this community are actually quite sophisticated. And so when I say like the internet might be the new world's like largest hedge fund, like part of that is the sophistication level of the people who are able to coordinate online, I think is higher than I think a lot of us expected. And I should say it's certainly higher than I expected going into this. The other observation I'd make, you guys talked a little bit earlier about like who made money and who lost money. There are a bunch of institutions, right? A bunch of actually hedge funds who actually made a lot of money through this thing. And the way they made a lot of money was they either already owned GameStop stock, right? So there were hedge funds that weren't short, but were actually long the stock and owned it, right? Or they bought stock, and basically became part of the movement, if you will. And actually made money. And so the Wall Street Journal did a story about one small fund that ended up basically making like $700 million in like a week, just because they happen to already be owning GameStop stock. And so one of the things you'll read in the press, when people want to get cynical about this, is they'll say, oh, it wasn't really the Reddit mob. It was actually these other institutions that were kind of trading behind the scenes. So it was actually like more like an Icon versus Ackman thing. And kind of this Reddit mob thing is just kind of the cover story for what was another one of these institution versus institution battles. And that's sort of the cynical way to look at it. And there's something to that. The somewhat more kind of, I think, dramatic way of thinking about it, which I believe is if the Reddit mob, or whatever you want to call them, if they can summon large institutions to operate sort of behind them and become part of their army, right, become part of their movement and line up with them on their side, right, then they actually carry a much bigger stick than I think people are thinking. And that's what I think actually happened. I think this started out as like a popular thing with like Reddit traders. And then I think a bunch of funds stepped in and provided firepower, behind this trade. And so the way to think about it is it's like I don't know, this mob of basically this mob of basically individuals without a lot of kind of individual power, who all of a sudden can kind of summon this other army, right? It's like, I don't know, it's like a kid on the playground who hires somebody really big to come in and be his bodyguard and beat up the bullies, kind of thing. And so I think that's what we're going to learn more and more about over the next several weeks. And to me, that actually makes this story more interesting and more dramatic, and not less, because it basically means that basically these mobs may actually end up being a lot more powerful than even we think right now.
Whoa.
No, I was thinking the exact same thing. Ben, do you want to jump in?
Do you want me to wrap it up, or do you want me to jump in with another idea?
Go ahead, Ben. Take it away, baby. You know how to do this.
Well, how about this? Wait, before we do that, I want to give Vlad a little bit more time to add maybe more context, or if he has any final thoughts he would like to add to the conversation before we shut it down. There you go, Vlad. It's your mic.
Hey, thank you. I really enjoyed this conversation, and I think just the thing that I worry about is sort of the iatrogenic nature of trying to solve these problems, which basically means the cure shouldn't be worse than the disease. And I worry a little bit that, by adding more laws, more regulations without thinking through kind of the consequences of that, you can stack more cards on the system, and that actually, in a way, could increase systemic risk. So we're going to do our part to do the best for our customers and make sure that they'll have a great experience becoming investors and using our product. And I'm excited to do that and also help the system however I can using what I know.
Thank you, Vlad. We really enjoyed having you, and I certainly would love to have you back on maybe in a couple of months to see how things are playing out for you. And Alex, I really want to thank you for your expertise, for joining as well. Alex, do you have any final thoughts before Ben wrap it up?
No, I think Vlad said it great. I mean, there are definitely lessons to learn, and there are things to, as Mark said, this is, in many cases, this will probably go down in history and people will write about this. And apparently there are 2 movies coming out about this, but you don't want to overtrain on this against the broader thing of providing financial empowerment and allowing people to invest in things. I mean, even if they invest in the wrong things sometimes, or maybe they invest in the right things sometimes, it's just, you don't want to have too many laws that prevent a progression of more people becoming investors. I think that's just fundamentally a good thing. So I would hate to overtrain on kind of the insanity. I mean, we should learn from the insanity of 2 weeks ago. And part of what you want to learn from the insanity of 2 weeks ago is, my big takeaway is make clearing happen real time. Like, we should do that. There's no reason not to. Like, that's a big takeaway. A big takeaway is not like, hey, let's overtrain on this. Everything, all investors are just going to invest in things like GameStop that might not have value, and maybe they go down and maybe they lose money. We have to protect them. We have to protect this. We have to stop that. Like, that's a bad idea. So kind of echoing, I think we have systems to actually deal with this today. And, the economic markets, it's like an organism. Like, there are feedback loops where if you make too much of this, your body controls it by doing that. And it's the same thing here. So I think I think the market will handle this. And, having more people become investors is fundamentally a good thing. So that's I guess, my final thoughts of the evening.
Thank you so much, Alex and Vlad. And I just want to check in to see if Mark or Michael Ovitz, do you have any final thoughts before we shut it down?
My final thought on this, Felicia, is I want to thank you for bringing this to everyone's attention in the clubhouse. It is I think this is such an important subject, such an important time in investing and actually for the internet, and to show that people can have a point of view that's shared, and they might have smaller dollar amounts, but they have a lot to say. I still feel that there's good news and bad news on this, as I said before. But I think when history looks at this is going to be a turning point for in the world of investing and pretty much in the world of how the internet is used for communications. So I think net, it's going to turn out to be a positive. Thank you for bringing it to everybody's attention. And Vlad, thank you. And Alex, you were fantastic.
Thanks, Mike.
Thank you. So, Ben, you ready to shut it down? We can have dinner.
Yeah. So
and thank everyone for coming.
Yeah, this has been an amazing conversation. And, I just always love listening to Alex on these topics because he knows so much about all aspects of them. And then Vlad, you've been great as well. And, of course, Mark and Fab and everyone. So thank you all. I had 3 kind of big thoughts about this kind of walking away. The first is goes back to something Vlad mentioned when he was talking about the mission of Robinhood and the importance of owning assets. And I think, look, for all the young people, if you're going to take one thing out of this conversation, I think this may be the most important thing because we've been going through, what our politicians have been doing in the United States, and I don't care what side of the aisle they're on, is kind of the opposite of Robinhood. They've been stealing from the poor and giving it to the rich, and in a very specific way, which is, and it's about to happen again, we're going to give you all $2,000. But if you keep your money in money, what that means is we're going to print $2 trillion to give you $2,000. And what that means is all your money, all your holdings in the future are going to be worth less in exchange for this short-term sugar high that makes you like us. And then the people on the other side, the rich, are going to take their money and they're going to buy assets. And those assets are going to go up in value, particularly because money is worth less. So relative to money, it's almost certainly going to go up in value. And so if you're not in that game, you're very destined to get poorer and poorer through the system that we have now. And so it's just really, whether it's Robinhood or whether it's something else, it's really important to know that your money is going to lose value unless you transfer it into something that's not getting inflated. And that's such an important point that Vlad made, and we went over it quickly, so I want to reiterate it. The second thing is what Mark said, which is this is a revolutionary moment in that we now have this new thing that we've never had before, which is collective financial action, where we can move the financial world through our collective will. And, Hammer and Fab, you guys are the great geniuses of moving the collective. And now, amazingly, you become dramatically more powerful. So I think, we got to spend some time really understanding what this means, because we just gave Hammer the nuclear weapon, and it's awesome. So I'm looking forward to that. And then the third thing, which really struck me, as we went through the complexity of today's system, is our financial system is an analog system. We fundamentally have an analog financial system. It's run by antiquated rules, poor technology, a government that doesn't seem to actually understand how it works, and regulation that nobody understands. That's the financial system. And it works okay given all that, but it is not as good as it could be. And it's interesting because, we've been talking in this clubhouse about a new financial system, a digital financial system based on not a gigantic pile of regulation, regulators, different kinds of systems, different kinds of incentives, but on math. And this system is called distributed finance. We call it DeFi in the vernacular. And just spending a lot of time in DeFi, it's striking that how all of the issues that we discussed today in the analog system are non-issues in the digital system. And there are still real scale issues in the digital system. There's still game theoretic issues and questions, about the system. But at this point, it looks like it's really going to be a much better system. And my friend Balaji had a tweet the other day saying, gee, we've gone from analog to digital and so many things. Why do people get so confused about we're doing it in money? And this really clarified that for me. So what a great conversation. Thank you all for coming, and have a great weekend.
Thank you. Thank you, Hammer, as well. How you doing, brother? With the nuclear weapon that you have now.
Thanks, Ben. That was great. What up, Hammer?
Thank you, everyone, for joining. And also, I think, Mark left the room, but on Monday, Ben, you and Mark have a show Monday at 5 or at 10. What time is your show?
It's at 7. 7 Pacific.
On the Clubhouse. So if you guys want to hear Mark and Ben chat it up, Clubhouse at 7 Pacific. Thank you all so much for joining, and stay safe. Bye, Vlad. Thank you.
Thank you so much, everyone.
What a great
Thank you. That was super informative. Thanks, guys. Yeah, what a great breakdown.
And Vlad.
Thanks for listening.
Thank you, everybody. Thank you for joining. Excellent. Thank you. What up,
Bye-bye.
Jules?
Thanks,
Thanks, Fab. Yeah, thanks for your
What up,
questions.
Nate? What up, y'all?
Hey.
Thank you, Ime.
Of course.
Thank you, Clubhouse.
Thank you, Clubhouse. Thank you, Paul and Rohan.
Yes.
Bye,
We in the house, y'all.
We in the house. Hammer, take care. Tell your family hello, okay?